Yeah, I think he certainly. Yeah, he comes out. That's what I like. He didn't hold back anything. Kind of fun. All right. So before we jump into the book, I know there's lots of good stuff there. Just going to talk a little bit about pension funds and finance companies, and then we'll kind of do the same thing for Wednesday. We'll wrap up the last little bit. We'll do the next chapter for it, and then there'll be we'll talk about hedge funds and mutual funds, and that'll pretty much wrap up chapter 13. So, okay, so pension funds. So pension funds were connected. Does anybody remember how pension funds were connected to life insurance companies?
Life insurance companies ended up basically managing a lot of pension funds because they had a pretty good track record.
Yeah. Yeah, just not being dumb with their money and trying to be conservative. So they ended up hiring life insurance. So there was just kind of a light connection to that. Otherwise, private pension funds are private companies that have a retirement program for their employees. And those can come in a couple different forms: a defined contribution plan and a defined benefit plan. And so we'll take a little journey into that. So pension funds. And pensions can be public and private. Social Security would fall into that category. We'll come back to that in a sec. So pension fund. So if it's private, it's generally just a company that provides its employees with a plan, retirement plan, under its control. And this is kind of where it differs from like a 401k. So a company provides its employees with a retirement plan, I guess is what I'm going to say, retirement plan under its control, under the company's control in some way, shape, or form. They might convey that control or management over to a life insurance company, but ultimately it's still held on the company books, which is different than a 401k. So with the 401k or 503b, which is what we have for Ottawa for nonprofits, the Ottawa University does a matching deal, so up to 5% of my salary, they put in money, I put in money, but that money goes outside of the university's books for the accounting people, right? So that's not out there. Once that money's paid out to, we use TIA-CREF, then that money's more under my control within some parameters of however it was defined with the 401k. In other words, the company can't ever grab it back. It's not their asset, it's mine. It's on my balance sheet. It's on my wealth creation once it's out there. Not the way a pension fund works. So a pension fund is going to stay underneath the company's control, and then they're going to kind of control the money on its way out. So we've got two cases. One is a defined contribution plan. A defined contribution plan. And the idea with this is that the benefits to the employee are determined or defined by the contributions made. So the title kind of runs itself, defined contribution plan, but we come back to saying the benefits to the employee after they retire are defined by what the money was put into the plan. That could be a combination of two sorts of money. It could have been the employee doing something, or it was just more likely a contribution by the employer into a plan. All right, that might become a little more clear if we look at the other type, which is starting to become a rare breed, by the way, and that is a defined benefit plan. So the benefits are determined prior to or at the start of employment, if you want to put it that way. Not necessarily prior, I guess you can use that word, but determined at the start of employment. So here's our deal for our employees. When you hit age 65, you'll start collecting a $2,000 a month check. That's our deal, period. So you're going to get a defined benefit at retirement. Usually, well, there's almost always going to be a vesting period. As long as you are with the company for 15 years, you will for sure get $2,000 per month. So that's the vesting period. Which also means if our vesting period is 15 years and you're only with us for 10 years, you walk away with nothing. You have to stay with the company that long. And that's part of the balance that they're figuring out, is that there'll be a certain amount of turnover with their employees, and so some of those people that they contributed to will not be there at retirement. So they're kind of playing that game. That's kind of their degree of freedom on how they work it. Okay, so questions on that so far? All right, so let's do a quick example here. Suppose we've got a $1,000 contribution per year for 10 years. And let's say that our vesting period is 10 years. So pull out your calculator. If you got your phone, we're almost got perfect here. Oh, we do have perfect. Oh, okay. So let's just go 1 through 10. Jason, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Let's assume that we can earn a 10% interest rate. What is the expected value of the fund at the end of 10 years? As a first step to this, on your papers, I'll come around and look, set up the problem with the equation. And I will help you out if you're not there. But you got $1,000 for 10 years. It's just $1,000 per year, so we're just doing simple annual compounding here. What does this equation look like to figure out what we have at the end of 10 years? The best thing to do, I think, in my opinion, is to start off with the raw formula, or that little one we talked about. If I have $100 in an account for a year at 10%, what do I have? To kind of jog your memory. Good. And now it gets a little bit more confusing with the summation sign with this one, right? Because we got 10 of those calculations. Yeah. But you got the first raw one, right? Yeah. And you're going forward in time, not backwards. So you're taking the present value and moving forward. Good. Yep. Yeah. So the sum in front of this one would work. Oh, that was from the other time. Okay. Yeah. Except we're taking a value and putting it forward into the future with this one. Because we got the $1,000. What is that 1,000 going to look like 10 years from now? Good, except we're going to not bring it backwards to present day. We're going to bring the present value forward. So in other words, instead of doing the dividing, we want to look at what is that thing worth at the end of 10 years. So we're actually bringing money forward in time rather than discounting it backwards this time.
We're looking for the value of that.
So we're going to take that 1,000 and it's going to ride for 10 years. Right? And then we're going to take a second time.
You're not making sense.
Okay.
Are you assuming the payments at the end of the year?
Payments are at the end of the year, yeah. We'll just do simple things. So let's all do this together. I wanted to give you a sense. It looked like most of you got on the right track here. So we got, we're trying to calculate whatever that future amount is. So the kind of the simple method is I've got that $100 times 1 plus the interest rate. If we want to put 10%, that's fine. Raised to the n power or the 10th power if we're talking about the first one. And that gives me the future value of that particular stream, right? So what's the future value of all 10 contributions? The future value is the present value. Oops, I had to do my sum there. The sum of k equal 1 to n of my $1,000 times 1 plus the 10% interest raised to the k power, where k equals 1 to n, which is 10. So it looked like most of you had this chunk, which is good. It's just kind of, now for this particular problem, we're bringing it forward in time rather than thinking backwards, like we did with our last problem. And now I want everybody to do a separate calculation. So starting with Jason is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So figure out who your number is. Oh, Katie, you got kind of left out. I guess you can do 10. We'll have you and Michael do 10 together. As soon as you get an answer, tell me what it is. So let's see, we'll go. I'm going to count backwards. 10, 9, 8, 7, 6, 5, 4, 2, 1. As soon as you get an answer, just tell me what you got. What'd you get? What number are you, I guess, first? 6?
17.
Okay. And we'll just, let's leave off the 2 decimals, I guess. We'll just round up. I'll call that 1772. Just to get a ballpark here.
16.
What are you, 5?
Yeah. Right at
1611, got it.
1464.
1464. 392.
No, I'm number 3. I'm number
$921 and then something's wrong. You shouldn't be higher than these guys. Yep.
1948.
Okay.
number 9, I'm 2,358.
2,350?
Okay.
58. Okay.
And then 2005.
2,954. 5. Okay. And who else are we missing here? 8 is 2144.
It was 29.50 or 25.94.
2594. And 1, 2, and 3? 1331 sounds good, or in the right ballpark anyway. 1210? 1,100. All right, good. Now add them all up. $17,533. Other people get that? Yeah, I see a couple heads shaking. As long as we get it. I didn't do this problem ahead of time. I just made up these numbers, so I need your help. All right. So 17,533. Everybody okay with the calculations? All right. So the reason I wanted to do this was to show you an important situation that a lot of pension funds have found themselves in, and that is being underfunded. So if the payment plan to this employee, if the payment plan to this employee turns out to be estimated to be less than what they got, then the pension fund is underfunded. Right? So if their expected payout is going to be less than 17,533, which could be a number of different reasons. The market didn't pay out as well on whatever they had invested in, or whatever the situation is. They had rough times in their company, and sales were off, and they robbed from Peter to pay Paul, or something like that. They'll run into possibly being underfunded. All right, so the two things that come up here is a fully funded and underfunded. Fully funded pension means that the future value, the expected payout to the employee is less than or equal to the future value of the pension. Then the company's in a solid position to not have any issues. Underfunded is just the opposite. So an underfunded pension means that the arrow goes the other way for those two things. So during the recession, this ends up happening quite a bit. And if you've watched a few movies, like my favorite, Wall Street, Gordon Gekko is famous for wiping out the pension funds when he takes over a company. Because they're on the company books, there's a large chunk of money, and with a corporate acquisition, the corporate raider can choose to reorganize things, and one of those things would be to liquidate the assets of the company, which includes the pension. And so that was a maneuver, at least it happened in real life, but it also in the movie Wall Street, of grabbing onto the underfunded pension. If the company's already going to go south, that's a risk that the employee took on. They didn't really think about that maybe when they did it, but that was part of the deal, is that if the company's no longer surviving, the company's not under any obligation, which is a little bit scary. Another reason why these are getting fewer and fewer out there of having this type of pension arrangement set up. Some of the unions, labor unions, will run their own pension fund, so they're running it privately like this. So my dad was a member of the Teamsters Union when he was an auto mechanic, And so he's pulling down a pension right now that was a fixed amount of money that he agreed to. He put in his 30 years of service, and he was only 54 because it was his first job out of mechanic school. And so he put in his 30 years, while invested for the pension, and is collecting a check ever since he was 54 on the pension. And then for his particular situation, he wasn't allowed to take another job that somehow competed with union jobs. And so he became a janitor at the local school and did maintenance work and ran boilers, got a boiler certificate, because a government job wasn't anything that was competing supposedly with a union job under their criteria. And now he collects a pension from them, because now he's 65, so he's got 2 pension checks coming in, one from the government thing that he had there, plus his one from out of him. So. All right, questions on that? So Penny Benny is the government institution that I'm not as familiar with, but Penny Benny is kind of the FDIC of pension funds. So like FDIC, it is a government organization that was created to insure pension funds. And so now the Teamsters Union or the private company can make premium payments to Penny Benny, and in the event that the company goes over or Gordon Gekko on Wall Street takes them out and wipes out the pension, then Penny Benny will cover their pension fund up to $54,000 per year per person. So there's a cap on it. So we have a max in 2013, which is the publication of this book, was $54,000 per year per person. What was FDIC again? What was the coverage there? $250,000 for deposits at a single financial institution. The 2015 amount I looked up was about around $59,000. It was a little $59,000 and some change, but that ratcheted up, and Penny Benny found itself in trouble, needing a bailout as well during the financial crisis. So, because once there's a number of defaults going on, an unexpected number of defaults of private companies, then all of a sudden Penny Benny is covering all of their pension amounts, and so they can run into. Yeah, you kind of question. I was surprised that it went up when I saw that the extra went up. So, but it's an insurance game. So in theory, the actuaries can take all the data and say, hey, it's be very unlikely that every single private pension fund would collapse all at the same time, and so we can create an insurance program to make it work. But once again, as John Allison might state, it gets harder and harder to predict those things if the government is steering the economy in other directions, maybe. Okay. I think that's all I wanted to say there. I just want to make a few passing comments on finance companies, which kind of especially rose during the 80s and 90s with like GMAC. So a finance company is a non-bank again. And does anybody know what those are? Remember, a finance company. What are they financing? I mean, what type of stuff does a finance company? No. No, I mean, they can sell, I think they can sell their paper on secondary markets. This has actually been a rise of subprime action here lately in the last 6 months. It's been what are they financing? Finance companies.
You're talking about like separate finance, like it could go almost like what car dealerships do.
Yes.
And stuff.
So GMAC was a finance company for General Motors, and so it was an offshoot of the company. Yes. Yeah, they're privately financing sales of their stuff. So Victoria's Secret's card, that's potentially a finance company, right? Best Buy, automobiles, all kinds of stuff. Any consumer purchases are generally the things that finance companies are doing. And so at first, they might run their own internal thing, so some still do. So again, they're financing it internally. They've got an accounts receivable that they have on their books. If some people don't pay, then their company's balance sheet suffers, right? And the income, part of the income from their company is not only from sales of clothing, but also interest payments from consumers, people who are running on the juice from their sales from previous. And so that's a finance company is one that has usually been spun off of that. Discover Card was a spin-off of Sears eventually when they started financing. So it kind of might lead them into turning into a credit card organization, but technically that's what a finance company is. They're not taking in deposits is the main thing, like a bank does. Okay, and those have been they don't fall nearly under the type of regulation that banks do, because they don't have that fiduciary duty to their depositors, right? So they've got their customers. Hey, if somebody defaults or does something else, then they just run with it.
So any company that has to have a negative credit card, is that necessarily a separate entity within their, like any small department store
Right.
that has their own credit card, is that necessarily a separate thing within their company?
It's completely up in the air. They could have, a lot of smaller ones wouldn't be able to handle all the infrastructure of messing around with it, so they'll team up with either a bank or another finance company to offer that type of credit at their business. Kind of like our life insurance pension fund thing. They'll kind of, hey, let's put our logo on the card, on the Victoria's Secret card or whatever.
Within, it could be within Visa or something.
Yeah.
It's not so good, it's a smaller thing. Like you said, they could handle their whole.
Right. Yeah. And GMAC, I think, branched into a number of different consumer purchases and got contracts with them. And what the company's likely doing is, let's say they sold $1,000 worth of clothing to a particular person, and that person zapped it, and so now it's on their account. The credit company is going to cash out the small company with $800. That money will be discounted. So they swiped $1,000 worth of sales, but as a convenience for running that operation, they'll take a hit on that, a haircut like we saw before. But then the small business will get, if it's a small business, they'll get that chunk of change up front. And then they don't run the risk of default with all the people. They kind of divorce themselves of each other at that point.
Didn't GM have their own credit card, or GM cards and things?
Well, I think it was always through GMAC. And then there's company loyalty cards, which are different. You can't usually charge balances on those if they're collecting points or whatever. That's more of a price discrimination, couponing type of scheme, if there's the loyalty program. And those two things can be run in tandem together too. So sometimes they'll be the card plus the loyalty program is one of the same. I think Kohl's maybe runs it that way. Okay, let's talk Allison. Yeah, let's see, Katie, sneak in there somewhere. I can get it, Jeff. Oh, just spilled it. Coffee.
Figured this was quicker than when we get paper towels.
Yeah, I thought you were kind of wipe your nose or something. Okay, so who wants to kick off things here? Let's let me get some of the people who haven't gotten a chance to speak quite as much to lead off with their opening thoughts.
Starting off the chapter on the first page, he talks about how the Fed and how it is by definition a government agency. So like they
Okay. So kind of starting off with the government, just recognizing that they are the government. Yeah, I thought that was interesting, the kind of the spin he put on it there. What else? What's that? Oh, okay.
I think it's some really old statements in this chapter.
Okay, which one's got your attention?
Like on page 18, he says, in my 40-year career, the industry has never been represented by the best and brightest bankers. just to say that out of all of those people, not one person who deserved the
Yeah.
job was in there. That's
Yeah, that was an interesting comment, wasn't it?
Since a lot of the women's of the workers are oftentimes more political than
Yeah.
actually being qualified.
Politically connected bankers. Now, we talk a lot about Wayne Angel. Do you guys remember some of his history with getting to the Federal Reserve Board? After I read that, I started thinking,
Did we have a connection with one of the guys, or like, when he connection with the chairman of the board at the time? I can't remember his name.
I think that came after some of his relationships with Paul Volcker, and he played tennis with Alan Greenspan regularly. But prior to getting there in the 1960s, Wayne ran for state representative. So that kind of resonated with me when I started thinking that they were politically connected, like he already had an interest in politics. So he's an economist that had political connections, you know, so that kind of resonated with me. And I was surprised that even at the banker level that it's the same thing, because I mean, Wayne was never a banker, he was an economist and a professor here. So, but it sounds like those political connections run deep and are apparently an important part of the mix here.
I'm not necessarily sure that you would want someone, though, on the Federal Reserve Board that didn't have an interest in the politics of the nation, though.
Yeah, I think you're right. It's probably at least part of the job, I guess. So.
To be purely political, but yeah.
Right. Hopefully not purely political.
One of the other bold statements that I made on page 31, he says, I said earlier that the Federal Reserve economists are intelligent. They are, but they have a specific kind of intelligence. They have a detached from reality academic floating abstraction form.
Yeah.
Right.
Is that also the same page that he talks about them being 100% wrong?
Yeah, that's 100% error rate.
Yeah. In my career, the Fed has a 100% error rate in predicting and reacting to important economic trends.
It just more or less sounds to me like the classic, well, you're book smart, but you're not street smart argument, but into better terms.
Yes, but I think it goes beyond that. I would just think not necessarily you got book smarts, but maybe not street smarts. Would he say that you can have enough street smarts to be good at doing it, or is it just not possible? Yeah, I think he's fallen into the Hayek thing there with. There's no level of smarts that can.
he even talks about Hayek in the chapter.
Mm-hmm. Yeah, I was actually above on that 31. It talks about the fatal conceit.
Which you can get away with in economics, but he really does need to kind of stay in his own lane. Like he tries to go into politics and into some scientific realms and global warming. He really shouldn't.
Allison.
Yeah. Honestly, it detracts from his entire point.
Like one of the topics that I thought was interesting was talking about the inflation and deflation and how much the government has control over the value of money.
Mm-hmm.
And I never thought about it, how he talked about if the government does not want the dollar to deflate, because then that makes the money that they're paying back their debt with more valuable. And I was like, wow, that's actually a good idea. That's a good point, because then why would the government ever want the dollar to deflate?
Mm-hmm.
And then it talked about how that because they have so much control over the value of money, like the trustworthiness of the value kind of is not there, which makes investing more risky, because you never really know how much the dollar's going to be worth tomorrow, because you don't have control over it. The government does.
On that point, on page 21, that you said that it's, I do a great deal of that to like the U.S. Treasury, and just to your advantage to have inflation because you're paying back your debt with cheaper money. I just thought that was interesting, like put it as cheaper, because isn't it almost more with the dollar change
Kind of the important ingredient that you need is that your payments are fixed with an agreed upon rate. So if somebody is holding your debt and it's a 5-year debt with a fixed interest payment, if there's inflation, it works to the benefit of the borrower.
These are not having to increase your fixed amount to what inflation.
Right. There's nothing. You're paying them back with cheaper dollars. They're not as valuable with inflation, and so if there's deflation, then we don't get that benefit because we're still the borrower, right? The United States has done wonderful at borrowing year in and year out for the last 30 to 40 years plus. China holds a large fraction of that, for example, and so if we keep hedging the inflation rate up, then it works to our benefit, our being the government's benefit. I mean, he kind of runs borderline conspiracy theory, doesn't he, with his talk? I mean, like,
he absolutely
It's
does.
just whose inflation's going up at a higher rate. I mean, at the end of the day, everybody's experiencing inflation.
Yeah,
For the most part.
I mean, he
No
brought up
government.
the differential rates of inflation for different goods.
I can't remember. Wasn't it principles you said that the goals of the government were essentially low unemployment, low manageable inflation, and I can't remember what the third one was.
Increasing real GDP.
Yeah. And so something that I was asked because I was tutoring somebody, and I told them that was the goal, and I didn't have the answer at the time. Now I kind of still don't. I was kind of curious if you did. Why is it searching for low and manageable inflation as opposed to trying to almost go through a period of deflation? Is it because of the points brought up on the debtor thing? Or is there another reason behind that?
So, and you know, to get away from the conspiracy theory thought, because I'm not a big fan of that.
Right.
They're following. The Fed has as kind of a dual mandate, if you will. Low stable inflation is supposed to be kind of number one because they're in control of monetary policy, and as Milton Friedman said, inflation is everywhere and all the time a monetary phenomenon at the end of the day, long term anyway. So the Fed's first focus is that, but then there's the so-called dual mandate is that they also want to do things that would help stimulate the economy potentially, or to stabilize real GDP so that we're doing things that lower unemployment, increase real GDP. Remember, those two things go together, so those two things are kind of one and the same. To help real GDP is to lower employment. But the inflation mix is where it gets a little dicey sometimes on whether they can successfully do that.
Alright, so what you just said, their main goal should be the prices. But according to Allison, on 18, it says that I have had numerous private conversations with board members over the years in which they readily admitted that the political pressure is to maintain low unemployment and not stable prices.
Yes. And that was the whole Phillips curve talk that you might remember from principles class, those of you who had me, which is most of you, but not everybody, with the 1970s, where the political pressure, the political environment was to pursue more low employment. The Phillips curve told us that over a long period of time, there seemed to be this trade-off between inflation and unemployment. And if I have to pick one of the two, I'll take low unemployment. Well, then the 70s came along and it turned into high unemployment and high inflation. And we're like, oh crap, the Phillips curve didn't work. And so then we had to, that's where part of Friedman's work with monetary policy and other things started taking place. Chelsea? Oh, I thought you said you were,
Sneeze.
oh, that's right, okay.
So,
I didn't hear the sneeze, I just heard the blessing.
have you started watching like the third season of House of Cards yet?
I just did last night.
So America works. It's going to happen. We
Yeah.
need to do it.
Yeah. Well, we'll try to stay off fiction land too much, except as it relates maybe to some of
I
the
mean, it
stuff
kind of
here,
does.
but The America Works plan.
You could do the unemployment.
This is probably, I was going to say, there's probably one of the better arguments for Moleskin that I've ever seen. It's always been tying back to Friedman's work, and he kind of one of the monitors thought of increasing money supply constantly about 25% a year.
And so the Fed has for whatever reason, unexplainable to me, because I'm not a monetary economist other than the liquidity trap and money not getting out the window, I've continued to be surprised that we don't see the upward pressure on inflation yet from the increase in the money supply that's gone on. And I just keep thinking this year that I've been saying the same thing for the last 4 years, that it's a-coming, it's eventually coming. And so we'll see if it goes. So right now, inflation's not an issue. And so if the Fed does pursue some policies that they claim will not be inflationary, then we'll see. And then, but I do know the tools that they'll need to do if inflation fires up, and it's going to not be an easy thing to rein in without putting a hammer down on GDP and employment. So. Chelsea, you got anything?
Yeah, it was kind of just a point, not necessarily a long one, but I liked that he taught, one thing I did agree with, that he was saying that on page 20, he says not all competitors make the same mistake, and different parties often make counterbalancing mistakes. So like a lot of times, like the government or like any regulator, their idea is to like fix like some mistakes, and those mistakes I guess do need fixed, but sometimes like the mistakes that other people make, like they counterbalance, so we don't.
Yeah.
And so then we almost have a double correction on mistakes because the government is trying to fix them, but if they would just let it play out.
Right.
Yeah, because they'll make those corrections, but in the long run, if they're not meant to survive in some harm,
They'll get corrected.
Yeah. Yeah, I think that was some powerful comments that even I didn't think about until I read this book, on thinking about that at the macro level, that because it's interest rates, and interest rates touch so many different factors of the marketplace, to hold those artificially low, even if kind of playing into that, his long run concepts of even knowing that that wasn't healthy long run, as a business person himself running this bank, you have to start to say, at what point do I still play the game, because the Fed can artificially keep them low a little bit longer, and for me to miss out on that opportunity, me as the bank watching out for my shareholder interest and everything, might be kind of quasi irresponsible. So then how do you, it changes, it really distorts his vision on how to run his portfolio.
I think you need a little bit of mixed modes. You need to have your own philosophy on the market fundamentals and be able to see what else is actually going on. The Federal Reserve absolutely impacts the short run, so you need to still incorporate it. It's more or less incorporated that way into your strategy.
I liked his analogy of the engineer, the yardstick.
Oh yeah. What page is that on?
I think it was just at the bottom of, yeah, it's the bottom of 20.
20. Yeah, and so Friedman's argument with the yardstick was that if we consistently, transparently, change the money supply, then we'd all know the yardstick, and we could all make more efficient decisions.
When they talked about, I don't remember what page it was on, but talking about during 2000 and 2003 on page 26, it talks about from 2000 to 2003, the banks, because of the, what they call the negative real interest rates, that's like when all the people, banks are loan. That reminded me of the video that we watched where, all the banks were pushed to loan out money even to people who, were more likely were going to default on the loan. And then that kind of just led to the destruction of the housing market, just because they, people took out these huge loans that they couldn't even afford to get these houses. And then, as he said earlier in the book, how that's like consumption, not an investment. I just thought it was cool to see the relation between the book and the video that we watched with that. And then also in my last book was it kind of, now that we're all going to be graduating soon, going out, just because the loan is available, or just because the credit card's available, doesn't necessarily mean that you're in the position to take on that loan.
That's right. Yeah. Good point. Well put. That's a good personal finance side of things, is that you guys will qualify for lots of loans. that doesn't mean you should take it. So be prepared to be honored with, I like the way Ramsey brings it in, like, you qualify, you're a member of the club, you know, some of the credit card type offers and other things. So, and same thing with housing, you'll qualify for a couple $100,000 loan maybe, but it might not be the right move for you.
And talk about like how you never know when like the interest rate's gonna rise or whatever, and then you're like stuck with like, oh, what did I put it in my black book? Like the poisonous apple, how just because it's there doesn't necessarily mean it's the right one for you.
Greg Moore mentioned something in our last semester. It was a finance class. I'm not sure, but he said in relation to loans, they're going to give you, or mortgages, they're going to give you the option of a fixed or a variable interest rate, and you should never choose the fixed, just because, in the long run.
Never choose the fixed?
I think so.
I think it might have been variable.
I was going to say never choose the variable as.
Oh, well.
That puts interest rates.
Just knowing Greg's conservative nature, I would say that
Right
he
now-
would say take, and it would be a 15-year fix, not a 30, by the way, too.
Right now, the difference.
And that'll
because-
raise your payment, of course, but.
Yeah, I mean, interest rates right now are kind of lower than they
And so
have been
they'll
for
eventually
quite a while, and
go
so they're
up.
eventually going to.
Yeah, if you
rise
guys
again.
get a chance,
So
I
if
mean,
you have an
there's
adjustable.
lots of other factors, but the variable rate, especially in today's environment, they're historically low, so if you want to lock in as long as you can. And even if interest rates are higher, sometimes it's still not a bad idea to lock it in to get rid of that interest rate risk, and then you just refinance later if they do come down. Because there's most consumer loans and consumer mortgages don't have a prepayment penalty, so if you refinance, there's not a penalty associated with that. So the interest rate will be a little bit higher on a fixed rate versus a variable rate, but you won't have that interest rate risk. Okay, what else here? Nobody brought up unemployment. Or I'm sorry, not unemployment, the CPI. Thought he made some interesting comments on that. Didn't they
Just
good
about how they
comment on that?
don't use the right calculation.
That was like 26, I see something. It might have even been on the time
it is
before that too.
He makes the same comment that I do every time you have me to run a core CPI. How is excluding food and gasoline lower?
And then they stripped out houses, which I had actually forgotten about until I reread this, that at some point during the Greenspan era, they stripped out the price of houses in the CPI as well. So all of that time that housing prices were riding the bubble, the consumer price index never reflected those price increases. So it was all on rental rates, which interestingly enough drug it down, because as housing prices are going up and everybody's buy a house, buy a house, buy a house, the rental market sags and rents fall. So now you have rental rates in there instead of housing prices, which is actually bringing the CPI, tending to bring it down. So you got this kind of double whammy of not including the one big ticket item that we're all paying on, and rental rates maybe not reflecting reality for housing as well. Okay, so read the next chapter for Wednesday. It's a little bit shorter, FDIC.